exchange ratio, if you remember, just a quick reminder, maximum exchange ratio. How do we get maximum exchange ratio? Is there somebody who is able to remind us the formula of getting maximum exchange ratio? Is there anybody who is able to remind us the formula of getting maximum exchange ratio? Yeah, first of all, yeah, let me review before I look at the past paper question. Let's review what we did. So maximum exchange ratio we said is that exchange ratio which will not lead to dilution of EPS. We don't want to acquire a loss-making company. We give it our shares, and then at the end of the day, our EPS is reduced. So if there is an exchange ratio that will guarantee that the EPS shall never be reduced, that ratio will be known as maximum exchange ratio. And to get this maximum exchange ratio, we normally take EPS of the target company, EPS of the target company over EPS of what here, somebody? EPS of the predator. This is very, very important for us. EPS of the targeted company over EPS of the predator. Very, very important. The other thing that I taught you in our last class is how do we get premium? Premium. Is there anybody who is able to remember the formula for getting premium? Anybody who is able to remember the formula for getting premium? Because that will be asked. Premium upon acquisition. Premium upon acquisition. Anybody who is able to remember something on premium? It's like I never did that. It's like I never did that. It's like I never did that. Then let me just look at one more stuff here before premium. Leave this out. So how about non-diluting offer price? How about non-diluting offer price? What we call the famous NDOP. Non-diluting offer price equals who times who. Non-diluting offer price equals who times who. I like what Mombi is telling me there. Muzembe, I mean. But first of all, let's go to this. How do we get this non-diluting offer price? Anybody who could be remembering this? Non-diluting offer price? Yeah, thank you very much, Elsie. We say non-diluting offer price is the PE ratio. PE ratio of predator. The PE ratio of who? Of the predator. Predator company is the company that is acquiring the other company. That is acquiring a smaller company known as what your targeted company. So you take the PE ratio of the predator times EPS. Times EPS of which company? Of a target company. Times EPS of a target company. I love this. Now, ladies and gentlemen, these are very, very important formula. However, is there anybody who could be remembering how do we normally get the general PE ratio? How do we get it? So this is price over earnings. So this is MPS. MPS over EPS. MPS over EPS. PE ratio equals MPS over EPS. So when we say PE ratio of the predator, PE ratio of predator, PE ratio of predator, it will be MPS of predator, MPS of predator, all over EPS of predator. Please write up to here, and the moment you write up to here, can you kindly give me a signal? Can you kindly give me a thumbs up? Tell me, Mwalimu, you're finished here. PE ratio of predator equals MPS of predator over EPS of predator. Once you write up to here, kindly give me a thumbs up like this, or a Y for yes. A Y for yes. A Y for yes. Or a Y for yes. A Y for yes. Thank you so much. I can see in this case here, guys giving me thumbs up. Then if you allow Mwalimu, I will be able to rephrase this. I'll be able to rephrase this. So then this one here will be the MPS, MPS of predator, MPS of predator over EPS of predator over EPS of predator times EPS of target company. Please write like that. So basically, I'm writing for you a rephrased formula of NDOP, the non-diluting offer price. non-diluting offer price. Instead of writing it like this, I'm picking it like this. It is NPS of the predator over EPS of the predator times now this EPS of the targeted company. Now, then let me ask you a question. In mathematics, if I'm given something like this in mathematics, 3 over 5 times 8. What is the final answer? Can somebody use their calculator? 3 divided by 5 times 8. What is the final answer? 3 over 5 times 8. What will be the final answer? 3 over 5 times 8. What will be the final answer? Audrey is telling me it's 4.8, right? 4.8. Thank you very much. Now, will this answer be the same if I were to swap numerators? If, for example, I was talk of 8 over 5 times 3, 8 over 5 times 3, will I still get 4.8? Will I still get 4.8? Will I still get, thank you so much. It will be the same. I can swap these numerators and still get the same answers. So, ladies and gentlemen, please, this is called commutative law. So long as you have a multiplication here, you can swap the numerators. You can swap the numerators, numerator will remain. We can swap the numerators and the numerator will remain. So meaning that I can take this refreshing of dope, I can take it a step further. My dope, non-diluting offer price will be equal to, please allow me to interchange. So in this case, then I can write EPS of the target over, you can see in this case here, EPS of predator will remain. I'm just swapping this and this. So this goes the other way, the other side, times MPS of predator. Now, let me ask you a question, my good students. Is there somebody who is able to see something very serious here? Is there anybody who is able to see something very serious there? There is something very serious here. There is something very serious there. There is something very serious there. Yeah, there is maximum exchange ratio. This is the formula for getting maximum exchange ratio. This is the formula for getting maximum exchange ratio. Meaning that if the examiner asks us to get non-diluting offer price, I will be taking the maximum exchange ratio times the MPS of the predator times the MPS of the predator. So if the examiner asks us to get non-diluting offer price, I will be taking the maximum exchange ratio times MPS of the predator. This is really, really important for me. Then I'll be able to go back to premium receivable by target shareholders. When we looked at this, because I wanted you first of all to appreciate this. How do we get the premium receivable by target shareholders? Now please listen, my students, please listen here. When you are a targeted company, so we have in this case here, this is the predator. This is the predator company, which wants to acquire a smaller company known as targeted company. So this targeted company, they have to sell their shares. They found themselves in some financial problem. So whether they like it or not, they are in between a hard rock, a hard place and a rock. So their back is at the wall. So they must sell, in this case, their shares. So there are two things here. It is either they sell their shares to the predator. They sell their shares to the predator at what we are calling a non-diluting offer price. Or they sell their shares to the market. So we have here market price per share. They go to the market and sell. They go to the market and sell. They go to the market and sell their shares. So it is either they sell to this one company, acquiring company, or they sell their shares to Nairobi Stock Exchange. Two things. For this company to be able to get all the shares from one company, If, for example, the market is giving, say, 10 bob per share to these guys, for this predator company to be able to buy shares from the tank, they have to pay a higher price. So, for example, they could pay like 12. The difference is what we are calling the premium on acquisition. When you are acquired, we should be able to get a better price. We should be able to fetch a better price. So anytime we talk about premium receivable, the premium receivable, I always take the NOP minus MPS of the target company. So what is this acquiring company offering me in undiluting offer price? What will this market, Nairobi Stock Exchange investors there give me? The market price of the targeted company. But do we know another formula of getting this NOP? Yes, I know it is MER times, in this case here, MPS of predator times MPS of predator minus MPS of target company. Minus MPS of target company. Could you guys kindly highlight this using the most conspicuous highlighter? The one that, of course, you'll be able to see quite fast when you're studying. And of course, it's always the yellow color. All these other highlighters are not effective highlighters. I could be, in this case here, having some leaning towards yellow. That's why even in my house, I've done yellow. Most of the parts are yellow. All right, not because of politics, but I know yellow is a conspicuous color. So I would want you guys to take here this premium, take this premium nicely like that. Premium. And for us to understand what Mwalimu is talking about tonight, I would want us straight away to look at November 2019 question number 5B. Let's look at November 2019 question number 5. Boy, once you get it, please put your thumbs up like this. UDA color. Pardon on NOP. NOP, what have we said? Non-diluting offer price. Non-diluting offer price, I've given you, you'll be able to see how I apply it here. You'll be able to see. Because I'm going to repeat everything. There. So November 2019, question number 5, boy. Once you get it, yeah, I can see in this case here, great signs there. November 2019. And if possible, you can even take a screenshot of that question and then you share it with our colleagues in the group. All right. So I want to start with part B. A Limited and B Limited are companies operating in the same line of business. In the past few years, A Limited has experienced stiff competition from B Limited to an extent that A is now contemplating acquiring B Limited. So A is the husband, B is the wife. A is the predator, and the B is the targeted company. The acquirer will always be the predator. The acquiree will always be the targeted company. They have given us information about A, information about B. Then required, number 1, they want us to give them the maximum exchange ratio. So is there somebody who can help us calculate this? Imagine this is very easy, 3 marks. Because all I'm required to do is to remember the formula of getting maximum exchange ratio. All that I'm required is to remember the formula. How do we get maximum exchange ratio? How do we get maximum exchange ratio, my daughters and sons? Most of you are, of course, my daughters and sons here. I doubt whether there's anybody here who is over 40 years. Most of you are 20, 21, 23. Those are my daughters, those are my sons. So the maximum exchange ratio, thank you. Oh, okay. Maximum exchange ratio, the formula is you take the earnings per share of the targeted company. Earnings per share of the targeted company. All over earnings per share of the predator. Earnings per share of the predator. Then EPS, earnings per share of the target company, is how much? Are you able to see? And now we are using this formula. Because this is maximum exchange ratio. It's not our normal exchange ratio. So if you look at this question very well, there's a place where they have given us earnings per share. Earnings per share of B. Remember, company B is our targeted company. Company B is our targeted company. Predator is A. And the earnings per share for B is 3. Earnings per share for A is 4. So this is our maximum exchange ratio is 3/4. We shall leave the answer in the form of fraction. So up to here, ladies and gentlemen, are we together? Up to here, are we okay? Up to here, are we okay? All right. And then I will be able to go straight away to number 2. Number 2, they want us to give them the premium. Rono, to get premium is very easy. Get premium, it's very easy. How do I get this premium? Yeah, premium, the very best thing, you take the maximum exchange ratio times MPS. MPS of Predator. MPS of Predator minus, in this case here, MPS of target company. From this table provided here, of course, maximum exchange ratio that already we have. But are you able to see the market prices? Are you guys able to see the market prices? Market from the table given, like the market price of A, which is our Predator, ladies and gentlemen, I can see down there that table, it's 60. It is 60. So this is 60 minus MPS of the targeted company. MPS from this table, MPS of the targeted company, I can see, ladies and gentlemen, the MPS there is what here? The MPS of the targeted company is 30. Is that okay? MPS of the targeted company. Market price per share. Market price per share of the targeted company. Are you able to see it somewhere there? Abracadabra. Market price of the target company. Adam has been able to see it's 30. Market price per share. It is 30, isn't it? 30. So this is 30. So then these will give me 45 minus 30, which gives me 15 per share. So this gives me 15 per share. And then, of course, they want us to give them the total premium. So I will take this 15 times number of shares of the target company, because it's the one that is selling their shares. Total premium. So it will be 15 times number of shares. So then this will be 15. If you look around, you're able to see the number of ordinary shares of a B, which is our targeted company, outstanding. Number of ordinary shares outstanding, yeah, times 3. Number of ordinary shares outstanding, you're able to see times 3. So 15 times 3, this gives us what here? This gives us 40, this gives us 45. Now, for the sake of CPA, no, I would want to use another method to tackle this. But up to here, ladies and gentlemen, are we together? But I would prefer this method a lot, because you can see like now what they're asking there. They're asking us there, Roman 2, the total premium the shareholders of B would agree to receive at the exchange ratio in B1 above. You can see you're using exchange ratio. These are very good method. Thank you very much. But now let's look at method 2. So we look at method 2. So this method 2, for getting this premium, you can come and use, in this case, the non-diluting offer price. And then you subtract this MPS of the target company from this. Non-diluting offer price minus MPS of the targeted company. And then I said, we'll come and tell you more. For this non-diluting offer price, it is offer price. So use the PE ratio. So we have here PE ratio of Predator. PE ratio of Predator times EPS of the target company. which I went ahead to expand this. I expanded this. I told you in this case here to get PE, it is the same as price over earnings. It is market price over earnings per share. So we say this law, we say that this law can be obtained by us taking MPS of predator all over EPS of what here somebody predator times now EPS of target company times EPS of target company like that. So in this question, is there anybody who is able to see the MPS of the predator? Is there anybody who is able to see the MPS of the predator? Anybody who is able to see the MPS of the predator? MPS stands for market price per share, 60. So you take 60 here, you divide this by EPS of the predator. So go to the other side, look for earnings per share. Earnings per share. I can see earnings per share. The other side of the coin, is there somebody who is able to see 3? Remember, not 3, but no. I'm wrong. I'm talking about EPS of predator. So EPS of the predator is 4. It is EPS of the target company, which is 3. EPS of the target company, which is 3. EPS of the target company, which is 3. So then is there somebody who is able to give us this non-diluting offer price? Final answer, they're telling me it is 45. In that case, then, I should be able to come and take this 45 minus the MPS of the targeted company. So 45 minus the MPS of the targeted company. Are you guys able to see the MPS of the targeted company? Please, thank you so much. Ensure you're participating. Market price per share of the second company. It is 30. So then 45 minus 30, this gives me 15. Remember, this will be shillings 15 per share times now the number of ordinary shares of company 2, which are 3. Don't return those millions, just leave them at 3. So times 3, that gives me 40 what here? 45. So I hope now CPA this is a little bit clear, but you bear witness with me that the first method is much better. I will never use the second method. But unless the examiner just asks for non-diluting offer price directly, I will never use the second method. Never. I'll always use the first method. Ladies and gentlemen, I will be able to go to, LC prefers the second grade. People are different. I like people are different like that. It's very good. So we look at Roman 3. So Roman 3, they want me to give them A Limited's post-acquisition earnings per share, assuming that the 2 companies agree on an offer price of 30. So they want me to give them post-acquisition for number 3. They want me to give them post-acquisition EPS. Listen, it's post-acquisition earnings. Post-acquisition earnings. So anytime you hear about post-acquisition earnings, always visualize the concept of post-marriage. After marrying, what happens? If we are a couple that is working, what they call the couple goals, the power couple, then we expect you to have the earnings of the husband and the earnings of the wife to be put together in the same bank account. It's post-acquisition, same bank account. And if possible, with mandate of just one signatory. And the one signatory should be the husband. Yeah, one signatory, and that signatory should be the husband. I mean, we are the heads of these families. It's biblical. We are the ones in this case who appointed ourselves there. If you trust us, then we shall be able to do much more exploits actually. Anyway, so whenever we talk about post-acquisition earnings, then will be earnings of the husband plus earnings of the wife. Great. Earnings of the wife. And then I will come and divide down here by our noses. So you take nose 1 plus nose 2, like that. But now remember, nose 2 has to be exchanged. Remember, company 2 is the targeted company. Company 2 is the wife. And for sure, the wife changes quite a lot. In marriage, if there is any party that changes, it is the wife, including, for example, her adopting my name. I mean, it's not easy to be a woman. Yeah, many things will have to change. So anytime you see number of shares of company 2, always remember to multiply this with what here? With the exchange ratio. With the exchange ratio. With the exchange ratio. And I'm not trying to scare anybody from marriage. Marriage is very good. Marriage is very good. But I can tell you, there are so many things that will happen to a lady. Yeah. Yeah. We shall overcome. 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 Now, please listen. This E stands for total earnings. Total earnings, also known as net income. Also known as net income. Net income. The NOS, NOS stands for number of ordinary shares. Number of ordinary shares. Number of ordinary shares. Then we have ER. ER stands for exchange ratio. Exchange ratio. Please write up to there. Once you finish, please give me a signal there. Please give me a signal there. We shall overcome. What is don't worry, don't worry. I'll sort this out. Don't worry, I'll sort this out. I'll sort this out pretty first. Don't worry, I'll sort it out. Don't worry, I'll sort it out pretty first. So is there somebody who gave out our link again, you guys? Who gave our link out there? Now people are disturbing us. Just a minute. Or you can't share the link. Then who is this who is really messing with my board? Who is this who is messing with my board here? So you can't share your whiteboard now. Yeah, you can't share your whiteboard now. Host tools. You can't start your video. You can't share the document with us. You can't share any notes with us. Lastly, you cannot collaborate with us in any app. Now, we can now see the board. Now we are okay. Are we okay now? Now we are okay now. Sorry for that. Sorry for that. Sorry for that. Sorry for that. So tell us there after right up to here that there are 2 types of exchange ratios. There are 2 types. There are 2 types of exchange ratios. There are 2 types of exchange ratios. Number 1, we have the maximum exchange. You must write this in full. We have the maximum exchange ratio. So this maximum exchange ratio, okay, repeat from post-acquisition kindly. Okay, so this post-acquisition EPS, we've said it's after what year? After you get married, you become 1. You're 1 thing, all right? Then you expect your earnings here to be put together. So post-acquisition, the earnings will be added. And then you divide this by the number of what year? Number of ordinary shares of 1 plus number of ordinary shares of what year? 2 times exchange ratio like that. And then I will just explain here. E stands for total earnings, net income. No stands for number of ordinary shares. And the ER is the exchange ratio. And I'm trying to expand on this ER exchange ratio. So there are 2 types of exchange ratios. We have our normal, or rather our MER. MER is maximum exchange ratio. Write that in full. MER is maximum exchange ratio, which is EPS of the target company. EPS of the target company over EPS of Predator. EPS of target company over EPS of Predator. And then number two, we have our normal exchange ratio. We have our normal exchange ratio. How do we get this normal exchange ratio? To get normal exchange ratio, we normally take the offer price over MPS of predator. Like that. So we have the normal exchange ratio. This normal exchange ratio we normally get by taking the offer price divided by MPS of who divided by MPS of the predator. Please listen, we normally use this. This normal exchange ratio shall be calculated when an offer price is given. When an offer price is given, we shall never use maximum exchange ratio, no. When an offer price is given, we shall always calculate a normal exchange ratio. We shall always calculate a normal exchange ratio. Now let's listen here, ladies and gentlemen. Let's calculate this, the post-acquisition EPS. So post-acquisition EPS, are you able to see in this case here earnings of company one? Are you able to see earnings of company one? Are you able to see earnings of company one? The net income of company one. Net income of company one. Company one is the predator. Net income of company one. Are you able to see that net income is 40? So net income here is 40 plus net income of company two. I'm just adding incomes of these fellas. So 40 plus 9. All over number of ordinary shares of the first company. Is there somebody who is able to see number of ordinary shares outstanding? First company. Is there somebody who is able to see 10 and 3? Is there somebody who is able to see 10 and 3? So 10 plus 3. Is there somebody who is able to see 10 plus 3? But now these three, we have to multiply it with exchange ratio. And I'm so sure so many students will tell you that Mwalimu, we got an exchange ratio above. Why don't we use 3/4? So many guys will tell me, Mwalimu, use somebody. Are you able to remember? We got 3/4 up there in Roman 1. Are you able to remember that? But we shall not use it. In this question, the examiner has given us an offer price. We shall not use it. Because this examiner, if you look at Roman 3, A Limited's post-acquisition earnings per share, assuming that the two companies agree on an offer price of how much they are, agree on an offer price of 30. So I don't know, you told me to repeat it, yeah? So the offer price is provided here. An offer price of 30 is provided. An offer price of 30 is provided. And therefore, I shall compute. The normal exchange ratio. An offer price of shillings 30 is provided, and therefore I shall compute the normal exchange ratio. How do we get this normal exchange ratio? To get normal exchange ratio, we normally take the offer price given all over MPS of the predator. So normal exchange ratio is offer price all over MPS of the predator. So offer price ni ngapi? Offer price in Roman 3, it has been given, it is 30. Offer price ni 30 all over MPS of the predator. Is there somebody who is able to see the MPS of the predator? 60. So 30 over 60. 30 over 60 will be equal to who? 30 over 60 will be equal to who? 30 over 60 will be equal to who? So please remember that all exchange ratios shall be written in form of fractions. all exchange ratios shall be written in form of fractions. So if you go to your calculator, when you've pressed here 30/60, you've gotten 0.5. Then you go to some other button. There's another button there called ABC. There's another button there called ABC. This is a fractional button. Just on top there, you're able to see ABC. You press that ABC. Then you're able to see that fraction coming a half. Exchange ratio shall always be written in the form of fraction. Exchange ratio shall always be written in the form of fraction. Always, always. So in this case, I don't use 3/4. We're using a half here. We're using a half here. Great. We're using a half there. It's because, ladies and gentlemen, in this Roman 3, the examiner gave me an offer price. Whenever an offer price is given, I shall always calculate a normal exchange ratio. I shall always calculate a normal exchange ratio, and that is what I've done. So I expect you ninjas to come here and they give us what here? Come here and they give us, in this case, the final answer. And you've seen in this case here, most ladies, when we say that we need a joint account, most ladies have told me, no, Wally, I can't do a joint account with my husband. And I understand. That is normally what happens outside here. It's maybe because we as husbands are not carrying ourselves very well. Yeah, I mean, you get even, I mean, I don't know, but perhaps my wife has a secret land. Yeah, most of the women who are married here, they have some secret land, which is not known to the husband. It's only known to the mother. It's only known to the mother. Is that correct? Somebody who is married, is that correct? Please be very honest with me. Be very honest with me. Is there somebody? Yeah. So we shall be able to discuss later on. You guys will be telling me why that is the case. Why should we take that route? You guys later on, you will tell me. So remember, this is not exchange ratio. This is EPS. EPS can be in form of decimals. It is only exchange ratio that are normally captured in form of fractions. In form of fractions. So Adam, don't give me EPS in form of what here? Fraction. It's only exchange ratios, which are normally in form of what here? In form of fractions. So if you want to be very correct here, remember you must use body mass. If you don't use body mass here, you can't be correct. So 40 plus 9 is 49. All over 3 times a half is 1.5. 1.5 plus 10 is 11.5. Body mass, multiply fast. Or use your calculators without saying equals, because you'll get a ninja saying 10 plus 3 equals 13. Then they take that 13 times a half, they get a 0. It is 10 plus 3 times a half equals at the end of the day. We say equals. So then 49 divided by 11.5 is what will give us the 4.26 like that. Is what will give us the 4.26 something here. So are we okay, ladies and gentlemen, up to here? Are we okay up to here? Are we okay up to here? Are we okay up to here? Thank you so much. Then we shall be able to go to Roman 4. So Roman 4, what do they want me to do in Roman 4? So in Roman 4, what they want me to do is something that is very easy. So in Roman 4, what they want me to do, ladies and gentlemen, in Roman 4 is something that is very, very easy. Anna has a problem. What is the problem, Anna? I would love to repeat. Is it how you used your calculator? Anna, I would expect you to ask a question. So as you type there, I could be doing Roman 4, where they want me to give them A limited post-acquisition EPS, assuming that for every 100 shares of B limited, the shareholders are offered to 12% debentures of shillings 500 per value. So they want me to give them post-acquisition EPS and the debentures are used in the acquisition. Debt instruments are being used in the acquisition. So they want me to give them post-acquisition EPS in a situation where instead of us giving them cash, instead of us giving them our own shares, they want us to give them debentures. 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 So, gentlemen, please listen. Please listen. Whenever they want us, in this case here, to use, whenever debentures or preference shares are used in acquisitions, then exchange ratio will always be equal to 0. Debentures or preference shares are used. When debentures or preference shares are used in acquisitions, then exchange ratio will always be equal to what here? Will always be equal to 0. Will always be equal to 0. Yeah, so somebody is asking, what if in this case here, offer price is not given? And somebody has answered you very well there. If the offer price wasn't given, then I would have used the maximum exchange ratio that I got above. All right. So, and we're learning something very good here, that when debentures, in any question, when you see debentures or preference shares being used in acquisitions, then exchange ratio will be equal to 0. Will be equal to 0. And then the formula then will change like this. So in this case here, the post-acquisition, post-marriage. So we have earnings of company 1 plus earnings of company 2. Remember, now we have debt. When we have debt, we expect interest. And the interest has always to be adjusted for tax. Interest must always be adjusted for taxation. Interest must always be adjusted for what here? For taxation. All right? All over number of ordinary shares of company 1. Number of ordinary shares of company 1. This is when debentures or preference shares are being used for the acquisition. Remember, ordinarily, down here, I would have had nose 1 plus nose 2 times exchange ratio. But we just say that exchange ratio is 0. So it will be nose 1 plus nose 2 times the exchange ratio, which is 0, which will give this. That's why down there I only have what here? I only have nose 1. What I've always found is that whenever there is interest here, then I'll always have just nose 1. I won't have nose 2 down there. Now, my good students, the very first thing that I will do then in this kind of a question is to ascertain interest. How do I get to ascertain interest? I must know the total debt given. The total debt given. I must know the total debt given. Is there someone who can read this question and tell me how much total debt is provided? I'll give you 2 minutes. How much is the total debt? From the question Roman 4, I can see it vividly. Because they have told me that the shareholders will be offered 12% debentures of shillings 500. But for every 100 ordinary shares they give us, we as the parent company shall give them 2 debentures worth 500. Out of that, then I should be able to get the total debt. Let me see who is going to nail this down. Let me see who is going to nail this down. Audrey, Nicole gives me a figure of 30. Audrey gives me a figure of 30. How about the other great ninjas? 30 million. Okay. Shall not return those millions. Leave it 30. So is there anybody who is not able to get that 30? Is there anybody who is not able to get that 30? I assist them. Is there anybody who is not able to get that 30? I assist them. Anybody who is not able to get that 30? I assist them. Already I can see ninjas getting even 3.6. Even 3.6. Already I can see ninjas getting even 3.6. Already I can see ninjas getting even 3.6. Ladies and gentlemen, remember they have told us that for every 100 shares they give us, we shall give them 2 debentures and each is worth 500. Forget the 12% first, because 12% is interest. So you're giving them 2 debenture notes. and each one is worth 500. Each one is worth 500. So what are we saying here? We are basically saying that for every 100 shares they give us, we are giving them a debt of 1,000. 2 times 500 is 1,000. And remember, this is a complete acquisition. So you must then ask yourself, this company which is being acquired, that is company B, the target company, how many shares does it have in total? How many shares does it have in total? This company which is being acquired. Number of shares outstanding. There are 3. Don't return those millions, don't return those millions. There are 3 shares. There are 3 shares. Don't return them. So then 3 shares, we shall end up giving them how much there in form of debt. So B has 3 shares. So cross multiply. So it will be 3 times 1,000 divided by 100. 3 times 1,000. Yeah, if you cross multiply. 3 times 1,000 divided by 100. That is how they got a debt of 30. And therefore the finance cost, which is the interest, the rate of interest is 12%. 12% of 30, that's why you saw some ninja saying that interest is 3 point what here? Interest is 3.6. So at least everybody now has been able to see where we got interest from. Then I'll carry everything and fix it up there. Carry everything and fix it up there. So in that case, ladies and gentlemen, our earnings in company 1. Our earnings in company 1, what do we have here? Our earnings in company 1, what do we have here? So earnings in company 1, net earnings, net profit, net income. Is there somebody who can see the net earnings, ladies and gentlemen, the net earnings for company 1? Oh, yes, I can see net income of 40. The other smaller company is 9. So we have 40 plus 9 minus interest, which is 3.6 times 0.7. I'm so sure I'm jaona nimetoa 0.7 wapi. I'm jaona nimetoa 0.7 wapi. I'm 100% sure I'm jaona. It's because of 1 minus tax. And tax, you've been told in the question, tax is 30%. You see, 30% is the same as 0.3. So 1 minus 0.3 will give me 0.7. Divide this by the number of ordinary shares of company 1. Number of ordinary shares of company 1, that must be 10. That must be 10. That must be 10. That must be 10. And then now here you go slowly, my friends. Let's go slowly, my friends, and say 40 plus 9 minus 3.6 times 0.7. First of all, you get the numerator. First of all, you get the numerator. So first of all, you get the numerator. So first of all, you get the numerator. First of all, you get the numerator. So the numerator, what do we have here for the numerator? What do we have here for the numerator? Is there somebody who is able to give me the numerator? 49 minus 3.6 times 0.7. Is there somebody who is able to give me the numerator? So they're giving me 46.48 approximately. So 46.48. We divide this by 10, which will give me 4.648. Like that. 4.648. Like that. That is the final answer. So do want at your own time ensure that you are able to rewatch this entire video. It will really, really help you form a very, very good base for mergers and acquisitions. Valuation of mergers and acquisitions. Valuation of mergers and acquisitions. Now you want in this case here to value a targeted company for purpose of acquiring it, or another company that we want to merge with. What are some of the most common methods we should be using to value them? Number 1 is what we call the discounted cash flow method. Discounted cash flow method. And I'm so lucky because you guys have already done net present value calculations. So I'm so lucky here. So the only thing that I need to do is to do a past paper question, you know. I just need to go and do a past paper question. Which question would I want to do, ladies and gentlemen? It is this question of May 2019, question 5B. where I get cash flows from RCM, discount them, get the stock present value. So we go straight away to May 2019, question number 5B. So we have here May 2019, question number 5B. Once you guys get this question, please put your thumbs up like this. Okay, so Elsie would want me to increase the light a little bit. A little bit. Do you think that is the very best? I increase the light a bit, or are you okay with that? Because Elsie, if I increase a little bit, I'm so sure really, because you know, I have I'm still working on my lighting. I have one big light here, which is reflecting on you. So if I try adjusting a little bit, Elsie, just vumilia. If I adjust it a little bit, it will be too much on your eyes. Trust you me, be too much. So long as Elsie, you are able to see it, you don't have to see me like being a little bit brown. No, let me be the black man. But in that case here, a black man with a white hat. Yeah, there's somebody who say that somebody is a black man with a black hat. I found that to be very insensitive. I found that to be very insensitive. Very, very bad. What is normally given to these young men? These young men, they are not very, very good. They are not very, very good. So I don't think then I will be the best place to introduce you to discounting. If I introduce you to discounting here, then I will take like a whole, waste my time here. All right. I would prefer if you guys can, like I saw somebody saying I haven't, there are things you have to do by yourself. Because already you have covered that in the videos. Just go and watch one video. Because I need to finish this and then I go to portfolio. I need to go to portfolio. I need to go to real estate valuations. Fortunately, now these topics will start in this case here following each other. The things will start falling in place because of that discounting. Yeah, they start following each other nicely and falling in place very, very nicely. So forgive me, I won't be the one introducing you to NPV because already there's a video. There's a video. What have you written, Hapo? Valuation of mergers and acquisitions. Valuation of mergers and acquisitions, May 2019. I'll try to make my handwriting very big now. May 2019, question number, May 2019, question number 5, Elsie we shall overcome. Elsie we shall overcome. Elsie we shall overcome. No, I don't think, yeah, Hazina, not Hazina. This is Excellent Limited. Excellent. 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 Excellent Limited. Excellent Limited. So Elsie, have you gotten the question, Elsie? Yes. Yes. Elsie, have you gotten the question? Perhaps Elsie does not have a very good phone. Perhaps Mwalimu should buy Elsie a phone. No, I'm joking. I'm not that rich. I'm not that rich. We shall overcome. I wish I was rich. I would have bought my daughters here, my sons here, something. Very good. Thank you so much. Excellent Limited. Excellent Limited is considering acquiring Best Limited, a firm in the same industry, in order to consolidate its market share. Best Limited has been less profitable, so it has paid an average of only 20% in taxes. Okay, Shady, I see you. During the last several years. In addition, it has used little debt, having a debt ratio of 25%. If the acquisition would be implemented, Excellent Limited could operate Best Limited as a separate, wholly owned subsidiary. This will increase Excellence Limited gearing ratio to 40%. The following is forecasted financial data for Best Limited over the next 5 years. The companies want to acquire. They've given us some data there. So we are told there risk-free rate is 8% and debt is considered to be risk-free. Expected return of the market portfolio is 13%. The firm's levered equity beta after acquisition is estimated at 0.8. After 5 years, the net cash flows of Best Limited shall increase at a constant rate of 6% per annum in perpetuity. Corporation tax rate is 30%. The firm's gross profit margin is 40%. Best Limited incurs financing cost of 2 million. firm's equity shares and bonds are currently trading at par. Determine the maximum price payable. Very, very easy. I will just derive the cash flows. How do we get cash flows? First of all, we get profits. How do we get profit? Very easy. To get profit, we take revenue minus all costs. So first of all, let's get then the profits here. So we have years 1 to 5. So we have 1, 2, 3, 4, 5. I will start with sales revenue. Abracadabra, sales revenue. What do I have there? Sales revenue, I have 50. I have 60 there, sales revenue. I have 75 here. I have 70 there. I have 65. I went to a good school, ladies and gentlemen. I'm so sure when I'm given gross profit margin, when I'm given note number 6, they've given me gross profit margin. Then there must be cost of sales. There must be cost of sales. An expenditure that 99.9% of the students in this sitting never picked. Whenever you're given a gross profit margin, then there must be always an expense called cost of sales. Gross profit margin plus cost of sales percentage must always be equal to 1. So then when you give me gross profit margin, to get this cost of sales, I will take 1 minus GPM. It will be 1 minus 0.4. See, 40% is the same as 0.4. So this gives me cost of sales of 0.6, which is the same as 60% of the sales. If you look at note number 6, they have given me gross profit margin. And they have told me that the gross profit margin is 40%. I'm repeating in finance. Whenever you see gross profit margin, the examiner wants to confuse you. And you get to forget cost of sales. And the cost of sales plus gross profit margin must always add up to what? 100%, or must add up to 1. And once I have the cost of sales percentage, then I will be able to apply it on this to get the cost of sales amounts. So 60% of 50, this gives me 30. 60% of 60, this gives me 36. This one you have to help me. 60% of 75, please help me. Please help me there. Please help me there. Please help me because I don't know 60% of 75. That is the same as 0.6 of 75. So that gives me 45. That gives me 45. This must be 42. This must be 42. And then we have 0.6 of 65. So this gives me 39. So many me just forgot this, and I'm repeating for the umpteenth time. Whenever you see gross profit margin, I shall always remember cost of sales. So that now I can get what we call gross profit. So that I can now come and get gross profit. So this will be 20. This will be 24. The other one, this is 30, very easy. Even this is 28. The other one, I don't want to start myself. I usually start myself when I have got daughters and sons here. 65 minus 39. 26. There are other crazily bright students. They'll tell you, well, even this method is bad. But the moment you give me GPM, the moment you give me gross profit margin, I'll only need to multiply with sales to get directly gross profit. And then I omit that step of cost of sales. Crazily great students. And when I see gross profit margin, but the gross profit margin, in this case, they've given me is 40%. So I'll take 40% of the sales and I will get these numbers directly. So that I omit the cost of sales. So if you take 40% of 50, 40% of 50, is it 40%? 40% of 50. Can somebody tell me what is this answer? What is 40% of 50? Will somebody be able to get 20 there? Will somebody be able to get 20 there? Yes. But I prefer, in this case, at times there are things I prefer going the long way. I prefer understanding that whenever the examiner gives me gross profit margin, I shall always I shall always look for cost of sales. I shall always look for cost of sales. I don't want us to go for this approach of geniuses. There are very few geniuses in this world. So once I get gross profit, then I can deduct the other expenses. So do we have the other expenses? Oh, yes. If I look at this note, I can see I have, first of all, I have operating costs. So are you able to see operating costs, ladies and gentlemen? Anybody who is able to see operating costs there? Oh, yes, we have 5, 10, 15. So 5, 10, 15, 5, 10, 15, 5, 10, 15, 15, 12, 15, 12. So reduct like this, reduct like this. Do we have other expenses? Oh, yes, we have selling and what here? Selling, and administration costs. Selling and administration costs. So selling and administration costs, we have 10, 10, 8. So 10, 10, 8, 10, 10, 8, 10, 10, 8, 9, 11, 9, 11, 9, 11, 9, 11. Do we have any other expenditure? Do we have any other expenditure? Yeah, thank you very much, Adan, for giving us that formula for gross profit margin. Thank you very much. Correct. So any other expenditure that I should be able to bring here? Please talk to me. Any other expenditure I should bring here? Yeah, finance cost, you're right. Look at note number 7. We have finance cost of 2 million per annum. So we have finance cost or interest, which in this case is constant at 2. Every year 2, 2, 2, every year 2, 2, 2. Every year 2, 2, 2 like that. We don't have any other cost. Don't take those acceptable projects. No. Those are balance sheet projects. Those can't be expensed here. We shall use them. The ones you're seeing there are acceptable investment projects there. The costs of no, don't bring them here. We shall use them to get what we call free cash flows. So come and give me the profit here. Profits before tax. So take the gross profit, subtract this. Give me the answers. Give me the answers. Very fast. Very fast. Very fast. So Audrey and Lillian, they're giving me a figure of 3 here. They're giving me a figure of 3 there. They give me a figure of 3 there. So we have the next one is 2. The next one is 2. I hope everybody is able to get these numbers. I hope everybody is able to get this number. Here. After that, the next one I'm being told is 5. Next one is 5. After that, we go to number 4. Number 4, we have 2. 2. How about year number 5? Year number 5, are you able to see year number 5? Year number 5 is 1. So this is profit before tax. So kindly come and share this with the taxman. Share this with the taxman, or which they have told us the taxman wants 30% of the profit. The taxman wants 30% of the profit. So the taxman wants 30% of the profit. So 30% of the profit, 30% of the profit, we are sharing this with the taxman. Remember, it's given there in note number 5, corporation tax rate is 30%. So 30% of 3, that gives me 0.9. This gives me 0.6. This will give me, I think, 0.15. This will give me 0. something, 0.06 or something, 0.03 or 0.3. No, why should I trouble myself? Why should I trouble myself? Why should I trouble myself? Oh, it's 1.5. They're telling me more, it's 1.5. 30%. Yeah, it's 1.5. Thank you very much. It's 1.5. I hope all the others are correct. So please, in this case here, come and deduct them for you to give me the profit after tax. Give me the profit after tax. Give me the profit after tax. The first one will be 2.1. The first one will be 2.1. Thank you very much. 2.1. 1.4. 1.4. 1.4. 3.5. Thank you very much. This must be 1.4 as well. Oh, no. 1.4. Thank you very much. And then lastly, we have 0.7. Now, remember, we are accountants. Once you get the profit after tax, the question is, how do you change profit after tax to cash flows? Can someone talk to me? How do we change profit after tax to cash flows? Because we don't discount profits. We don't discount profits. We want to discount cash flows. You add back depreciation. Thank you very much. Add back depreciation. Add back depreciation, of which in this question there is none. In this question there is none. Then once I do that, I'll be able to get what I call my operational cash flows. Operational cash flows. One, two, three, 4, 5. So now I have my operational cash flows. So these are of course copied them the way they are because I'm adding. So 2.1, 1.4. So we have 3.5. We have 1.4. We have 0.7. Ladies and gentlemen, these operational cash flows here cannot be given to the new people who are coming to buy this company. No. The company must always retain some cash flows for future expansion, even to replace its assets that have been worn down, wear and tear. So we need, in this case here, before we get what we call free cash flows, we need to come here and less. Never forget this. CAPEX. CAPEX. CAPEX stands for capital expenditure. CAPEX stands for capital expenditure. So basically, these are reserves. Reserves. At times, the examiner will use the word retained earnings. You must retain something. These new people cannot just come and then you start telling them that, you know what, these are the total money we have. People are greedy. They want to distribute everything as dividends. As dividends. So is there somebody who is able to see this? That language acceptable. Acceptable investment, acceptable. So we have here 0.5, 0.7. 0.5, 0.7. 0.5, 0.7. Then we have 1.6, 1.2. 1.6, 1.2. 1.6 and then 1.2. And lastly, we have 0.2. 0.2. So these reserves retain the earnings from our operational cash flows. We must retain something within the firm for us to be able to get what we call the free cash flows. So for us to be able to come now and get what we call the free cash flows. So come here and give us the free cash flows. So come here and give us the free cash flows. Free cash flows. So like 2.1 minus 0.5. 2.1 minus 0.5. Please give me these answers very fast. You guys are tired. You want to sleep. So somebody is giving me a figure of 1.6. 1.6. 1.6. Next one will be 0.7 if I'm not wrong. 0.7. How about year number 3? Year number 3, we have 1.9. Being told this 1.9. This I can see with my own naked eyes. 0. Even this one I can see very, very clearly. 0.5. 0.5. So now I have what we are calling the free cash flows. I have what we are calling the free cash flows. I will be able to skip like 5 lines to count them. 1, 2, 3. To skip like 5 lines for you to be able to get, in this case here, what we call the WACC for discounting purposes. Because now we need to discount this for discounting. WACC for discounting. When you get WACC for discounting. Remember, this is worker car. And to get this worker car, We normally take weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus tax. Into 1 minus tax. I need this worker car, even for computing the perpetuity. There's something called perpetuity. I need this worker car for doing many things. So I've skipped here like 5 points. So worker car is weight of equity, cost of equity, plus weight of debt, cost of debt, and the cost of debt must always be adjusted for tax. I don't have a problem with this. These are weights. I will always start with weight of debt, because the examiner will give you weight of debt. The examiner will call it like here, the examiner will call it gearing. Gearing the same as weight of debt. Are you able to see the gearing? Is there somebody who is able to see after acquisition, the last sentence before the table? After acquisition, this will increase Excellent Limited's gearing ratio to 40%. Anybody who is able to see 40% gearing ratio? Gearing ratio is the same as weight of equity, weight of debt, I mean. Gearing ratio is the same as weight of debt. So they've given me weight of debt is 0.4. Then what do you think will be the weight of equity? Will be 1 minus weight of debt. So it will be 0.6. So at least these two, I've taken care of them. Weight of equity and weight of debt, I've taken care of those two. Now I need to take care of the others. As a scholar of finance, I know KD will be very easy to get. As a scholar of finance, KD will be the easiest here to get. So is there somebody who is able to tell me what the value of KD is? KD. KD is cost of debt. This is cost of debt. KD is cost of debt. So cost of debt, ladies and gentlemen, in most cases, it shall be provided. They will tell you cost of debt is 10%. In the absence of cost of debt, I shall always assume that debt is risk-free. In the absence of a cost of debt, I shall always assume that it is exactly equal to risk-free rate of return. If you look at note number 1, they've told us the risk-free rate of return is 8%, and the debt is considered to be risk-free. Most of these well-established banks, their debt is normally risk-free because it's very well collateralized. It's very well secured. The security here. So debt is normally considered to be risk-free. So it's just then somebody who is able to see that the cost of debt is 8%. So it means that KD is 8%. So KD is 8%. So as a scholar of finance, I know where this, at times, ladies and gentlemen, you'll get people who play some games without knowing that, the end, how the end will look like. Like right now, I'm so sure Gachagua and our great president here, they're into some kind of a game whose end nobody knows. It's quite a bad experiment. All right. So here I know my end game. I know how I'm going to end this game. I'm so sure once I've gotten these two, now I've KD, I know what tax is. The examiner would want me to blunder in KE. The examiner would want me to blunder in KE, but I'm not the type that will blunder there. Because I blunder in this, and then I'll be able to get almost a 0 in the entire question. So the question is, how do we get KE? So here, I'll use the famous CAPM. CAPM is capital assets pricing model. Capital assets pricing model. CAPM. Capital assets pricing model. So if you remember very well, for us to get CAPM, capital assets, ladies and gentlemen, remember CAPM is a model for the rich. And if you are here, is there anybody who is rich? Is there anybody who is rich? Myself, I normally consider myself rich. Yeah. Because I'm hardworking. Most of my colleagues are not teaching at 10 p.m. Me, I'm here teaching so seriously. And I'll wake up at 5 a.m. right, to teach. So I normally consider myself to be rich. Why I consider myself to be rich is not because of the many hours I'm pumping into teaching. It's because I know the 𝐂𝐿 model. 𝐂𝐿 model tells you that whenever you're planning for your investments, ladies and gentlemen, whenever you're planning for investments, ladies and gentlemen, you shall always start with risk-free. Anytime you hear of a 𝐂𝐿, capital assets pricing model, we shall always start with risk-free assets. Risk-free assets. Plus, in this case here, ERM minus risk-free multiplied by beta equity. Multiplied by beta equity. A very, very important formula called 𝐂𝐿. There is no AFM exam that can ever come without this formula being used. Rich in health, I love that. Rich in health, I love that. That's very good. That's very good. Rich in faith. Rich at heart. Yeah. So 𝐂𝐿 cost of equity is risk-free rate of return, ERM minus RF BE. So this RF stands for what here? Risk-free. Risk-free rate of return. Risk-free rate of return. ERM stands for expected market returns. Expected market returns. Is there somebody who is able to see the risk-free rate of return in this question? Anybody who is able to see the risk-free rate of return in this question? Risk-free rate of return, yes, it's 8%. Yes, it's 8%. It's 8%. Is there somebody who is able to see the expected market returns? Expected market returns, 13%. It's given number 2, expected return of the market portfolio, 13%. 13%. Then we have BE. So BE is beta equity. BE is beta equity. So is there somebody who is able to see beta equity in this question? It's given there. It is in note number, it's note number 3. The firm's levered equity beta after acquisition is estimated to be 0.8. Then is there somebody who is able to give me these 𝐂𝐿 returns? Plug in. Risk-free, we know it's 8%. Plus into bracket expected returns of the market, we know it's 13%. Minus 8% multiplied by BE, which is beta equity, which is 0.8. So is there somebody who is able to give me this number? Anybody who is able to give me? Please ensure you're watching your abracadabra body mass. You can even call this 0.08 plus open bracket 0.13 minus 0.08, you close, and then you say times 0.8, and then you say equals only at 1 point. You say equals only at 1 point. So all of us, are we able to get that 12? All of us, are we able to get that 12? All of us, are we able to get that 12%? All of us, are we able to get that 12%? All right. Thank you very much. Now, ladies and gentlemen, after I get that, the next step will be for me to come and give my examiner, the infinity cash flows. I need to come and give my examiner the infinity cash flows. So infinity cash flows. Infinity cash flows. Infinity cash flows. So whenever they talk about infinity cash flows, I will always remember the person in this case here who always believes in this perpetuity. Perpetuity. If there's anybody who never ever thought that these kind of things that are really coming his way would ever come is Gachagua. Gachagua. Yeah, Gachagua. So in this case, whenever we talk of dividend evaluation model, so we shall always remember Gachagua's model. Don't write it like that. It doesn't have any model. It's just for our class here. So Gachagua's model like that. Yeah, Gachagua's model. I don't know whether it's S or a C, whichever. All right. So whenever we talk about infinity, which is the same as perpetuity, indefinite, we shall always remember our man who was in the provincial administration. He started from this position of district officer and he grew by ranks all over Kenya without government. Yeah, try chasing the guy. This guy's got nothing to lose. And 𝐂𝐈𝐅𝐀 Gachagua is a dangerous person. Yeah. Yeah. So in this case here, DO into 1 plus G all over Kenya without government. But please, Gachagua should not be chased away by anybody. Remember, he has never been one of my very best friends. Yeah, because the guy is really a loose tongue. But where it has reached, we know that the biggest problem we have in Kenya is not Gachagua. There are many, many other problems here. Wacha now wazee, unajua amefika 50 kama is 59. So and he's still energetic. Utakaenda wapi? Wacha na yeye mzee amalize. Hiyo time nyingine utajipanga. Lakini kwa sasa hakuna haja, it destabilize so many things. It destabilize so many things. So remember, this PO stands for what here? For market value per share, current. Current because of 0, current market price per share. Then we have DO. This is the current dividends. Current dividends per share. Current dividends per share. Current dividends per share. Current dividends per share. So DO, there's no D1 here. So DO is current dividends per share. Then we have KE. KE is cost of equity. Cost of equity. Then we have G, which is growth rate. So this DO into 1 plus G is what we call D1. Somebody may omit this and then talk of D1, but this KE minus G. But I prefer pulling it from here. So whenever you go to a question and then you realize the examiner is talking about perpetuity, then we shall always remember that formula. We shall always remember that formula. Very, very important formula. Very important formula. Very, very important formula. Very important formula. However, I would want you to know one thing, that the firm that we have has both debt and equity. The firm that we have has both debt and equity, and therefore for firm valuation, we shall use the following formula. For firm valuation, we shall use this formula. PO equals DO into 1 plus G all over 𝐂𝐶𝐂 minus G. Because remember, our cost of capital is not just KE alone. We have debt. We have a gearing ratio of 40%. So it's 2 of them. So for firm valuation, we shall be using this. Later on, you'll be seeing that for ordinary share valuation, we shall only be using KE because you see ordinary shares, now we're not looking at the debt component. So now here, you're asking so many questions. You have you're not able to follow something, Yeah, because you see, we said you skip like 5 lines and then we shall come back. So now we are trying to value this infinity here. You're trying to value infinity. Just relax a little bit. You're trying to value infinity. All right. So for firm valuation, we're trying to value a firm here. We shall use this formula here and use what we call 𝐂𝐶𝐂, the one that we have just gotten. All right. Now, please, I'm just borrowing this formula to help me answer this. So do we know the most current dividend? The most current dividend will be the most current cash flow. This one here, 0.5. Have they given me this perpetual growth rate? If you look at note number 5, after 5 years, the net cash flows of Best Limited shall increase at a constant rate of 6% per annum in perpetuity. So 0.06. Is there somebody who can remember what our 𝐂𝐶𝐂 was? Anybody who is able to remember what our 𝐂𝐶𝐂 was? Anybody who is able to remember our 𝐂𝐶𝐂? Great, Sylvia, I'll be able to answer that. So 𝐂𝐶𝐂 was 12%. So we have here 0.12, 0.12, 0.12 minus growth rate, which is 0.06 like that. So then can you kindly go slowly and give me the numerator first before I answer this lady? Go slowly and give me the numerator. So 0.5 times open brackets. I know the denominator will be 0.06. Denominator I know 0.06. How about the numerator? How about the numerator? 0.5 times 1.06. Is there somebody who is able to give me this answer? Oh, we have not yet gotten 𝐂𝐶𝐂. Tunapotea wapi? We have not yet gotten 𝐂𝐶𝐂. Ala, shida ndio hii sasa. Tunafaa tumalize tulale sasa. Shida ndizo hizo sasa. Shida ndizo hizo sasa. So then let's finish here. How do we get this 𝐂𝐶𝐂? To get 𝐂𝐶𝐂, we take weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus tax. I remember very well this weight of equity was 0.6, and the cost of equity is the one that is 12%. Weight of debt is 0.4, cost of debt in this case is 8%. 1 minus 0.3. So is there someone who is able to give me this 𝐂𝐶𝐂? I'm sorry for that. I'm sorry for that. Anybody who is able to give me this 𝐂𝐶𝐂? 9.44. I hope all of them are able to get that 𝐂𝐶𝐂 of 9.44. I hope all of them are able to get that 𝐂𝐶𝐂. Remember the weights, we had gotten the weights. Everything we had gotten. 9.44. Everything we had gotten. Everything we had gotten, yes. Thank you so much. So I'll come and replace this with 9.44 before I answer Sylvia. Yeah, you're almost finishing. I'm so sure you guys are very, very tired, but just hold on to this. You'll be able to like this. You will like this a lot. But you never gave me the numerator. You never gave me the numerator. Nobody gave me the numerator. 0.5 times 1.06. Nobody gave me the numerator. At least the numerator was correct. The numerator was correct. 0.53. So I'm being given the numerator as 0.53. How about the denominator? The denominator will be 0.0344, which will end up giving me what figure? 0.53 divided by 0.0344. So the quotient, is there somebody who is able to give me the quotient to this infinity cash flow? $15.41, $15.40, one and the same, so 15.41. Thank you very much. Thank you very much. So now up to here, as I answer Sylvia, remember Sylvia, this company has got what here? This company has got debt in it, yearly 40%. And it has an equity need. So the only way out of getting the cost of capital for discounting is you to come and give us the weighted average cost of capital. Yeah, because it has got gearing, it has got debt in it, it has got equity in it. So the only way out is to come and consolidate like that. All right. So in this case, you can come and discount. So how do we discount? So to discount here, we are going to use PVIF. For the sake of Ronald, who said he has not attended the class here, remember we have got two types of cash flows. We have two types of cash flows. Two types of cash flows. Which cash flows are these? These cash flows, ladies and gentlemen, we have what we call irregular, and regular. Irregular are the non-uniform. And if you remember irregular, we normally use what we call PVIF. The regular, also known as the annuities, we use what we call PVIF. So like now these are irregular because they are fluctuating. So we shall use PVIF. We shall use PVIF here. And this PVIF formula is 1 plus R raised to the negative n. Remember, our discounting required rate of return is the worker car. So basically here, I'm using 1 plus, here I'm using 1 plus, 0.0944 raised to negative n, which will be 1.0944 raised to negative n. So I come here, the first n is 1. Is there somebody in 4 decimal places who can give me the PV for year 1? Using this, you say 1.0944 raised to minus 1, raised to minus 1, raised to minus 1. Anybody who is able to give me that answer, raised to minus 1. So 9137. So we have here 0.9137. How about the same, but now raised to negative 2? The same raised to negative 2. The same raised to negative 2. 1.0944 raised to negative 2. What are we able to see there, ladies and gentlemen? What are we able to see there, ladies and gentlemen? Raised to negative 2. Now 84, 83, 49. We are finishing this in the next 3 minutes. 8349. Next 3 minutes will be out of this place. Roman 3, not Roman 3, but year 3, I mean. When n is 3, 7629. 7629. What about when n is 4? When n is 4. When n is 4. When n is 4. So when n is 4. 6971. 6971. And then lastly, when n is 5. When n is 5. When n is 5. So 1.0944 raised to negative 5. Yeah, the worker car is what we shall use as the rate of what here? As the rate of discounting. So 0.6370. So we have here 0.6370. Then remember, this is quite confusing. Here, you were able to discount this in infinity cash flows up to the end of year 5 or beginning of year 6. So what we normally do, to be able to get the discounting factor for this, you simply slide the same figure, put it here, 70. Slide the same figure and put it here, put it there. Then go ahead and do your multiplications here. 2 decimal places now. Go ahead and do your multiplications there. 2 decimal places. 2 decimal places. 2 decimal places. 2 decimal places. So come and give me the discounted cash flows, or what we call the PVs, present values. 2 decimal places. 2 decimal places. 13.41. Is it 13 or 15? It's 15, eh? My handwriting is the one that is very bad. It's 15.41. 15.41. Paul, are you able to see 15? It's 15. Okay. 1.46. The first one is 1.46. How about the second one? 0.7 times 0.83, 49. 0.58. 0.58 for year 2. Thank you very much. 0.58 for year 2. And then for year 3, we have this times this. 2 decimal places. 2 decimal places. 1.44. 1.44. And then year 4, 0.2 times 0.6971. 0.2 times 0.6971. 1.45, right? Oh, 0.14. 0.14. Then you go to year number 5. 0.5 times 0.6370. 0.32. 0.32. So this is 0.32. And then lastly, we have this and this, which will end up giving us what figure? Lastly, we have 15.41 times 0.6370, which will end up giving us 9.82. 9.82. So therefore, the farm value, will be equal to the total numbers. You add them up. Total farm value will be the total of all those. Year number 3 is 1.45. Year number 3 Please check this out. Here number 3. 1.44 and 1.45 the same. I can't rub this same. The same. 1.45. They want me to use 1.45. Okay. All right. Well, the same. Don't rub yours. So total farm value, we are able to get 13.77. 13.77, and that is the answer. Thank you so much, ladies and gentlemen. I'm so sure today's lesson has been a heavy one, because now, once you start hearing Mwalimu raising the sound a little bit, once you start hearing Mwalimu raising the volume a little bit, know that now exams are around the corner. That's how I gauge even myself. Once you start seeing that the Mwalimu has started raising the volume a little bit and the speed a little bit, because now I have to crash this topic, start portfolio, all right, and real estate finance, as my colleague, of course, is also hammering the other topics like that. And then we shall overcome. Others, thank you very much. Bye for tonight. Bye. Okay, Gloria, I've seen that. The 15.41, 15.41, I think 15.41 has a problem. Somebody is asking there about this 15.41. How do we get this 15.41? Because of the infinity, we came under infinity cash flow. It's called infinity cash flow like this. How do we get this? It's PO, which is the rho into 1 plus G over worker car minus G. So what is our most current dividend? Our most current dividend before we got this, what is what we are looking for? Our most current dividend was this free cash flow, the 0.5. We took the 0.5 here in 1 plus the growth rate. The growth rate, the perpetual growth rate we got here, it's given in note number 4. The net cash flows of best limited shall increase at a constant rate of 6% per annum into perpetuity. So that perpetual growth rate is 0.06. All over the worker car, we got this one as 0.0944 and at 0.06. So now you go slowly body mass. It's about body mass. So you take 0.5 times this, which gives us 0.53. 0.53 divided by 0.0344, if I'm not wrong. So if we divide, that's how we got that 15 point something. If we divide, that's how we got that 15 point something. And remember, we calculated the perpetual cash flow because we are told in note number 4, after 5 years, things are still happening. After 5 years, we are told after 5 years, the net cash flows of best limited shall increase at a constant rate of 6% per annum in perpetuity. In perpetuity. So does that make some sense? Does that make some sense now? Great. Any other questions? Yeah, you're 10 marks, yes. What about K? Is it KT or something? KD. Yeah, great. So remember KD is cost of debt. And the cost of debt in most cases will be, if it's not given directly, to be risk-free. And even the examiner insinuated something regarding this. Number 1, he said the risk-free, not number 1. The risk-free rate of return is 8%, and debt is considered to be risk-free. That's how we choose. We chose 8% for our KD. KD is 8%. Thank you for that question. Any other question? Yeah, good night, Adam. See you. Good night. Natalie. Great. Yeah, good night. Thank you so much, ladies and gentlemen. Bye. You can leave at your pleasure now. Yeah. Bye.